Hey everyone, so excited to be back for part two of our series going over leveraging. I will not be taking questions today. As usual, we would ask that you email those to us and we will answer them on social media or develop content around those questions. As a matter of fact, a lot of this series actually came from questions from people just like you. It gives us great direction on what education you want to see and where you can find the most benefit from what we are doing to bring this content to you. I want to ask you now to take out your camera. We have a lot of QR codes. You, of course, will get a link to rewatch this after the fact, or you can always visit our website at www.wealthandrentals.com to also find all of this information. The last two parts of our series are going to be October 19th and November 2nd. On October 19th, we're going to talk about the entire tenancy process. That is the backbone of everything that we do. That is what makes or breaks your investment. You can have the best property in the best area, but if you're working with the wrong team or using the wrong leasing model, it all just falls apart. And then after that, we're going to talk about our 2 to 6 year process, how doubling your portfolio works, what that looks like, and how you have the right properties to make that happen. So you can use either of these QR codes, or of course you can visit either of our links, slaughterinvesting.com or wealthandrentals.com. We're going to have a live event October 10th in Richardson. Would love to see everybody there. We're going to be talking about passive investing and what that is, why it's a great benefit, and what opportunities we have for you. Our virtual bus tour is going to be a couple days later on October 13th. This is a free virtual bus tour talking about our top markets, why we love those markets, what's happening there, and what type of off-market properties we are working with on a daily basis. And then we have 3 more bus tours in person going over the same thing. That's going to be October 28th, November 18th, and December 8th. Each of these runs all day and the cost is $50. And then finally, our last event of the year is going to be our Wealth and Rentals weekend. We have our conference on the 8th. We'll have a bus tour during the day, our conference in the evening. And then for those of you that are part of our inner network, we have our big party on Saturday. And I just can't wait to see everyone there. If you haven't gotten an invite and you think you should, please reach out to us. At Wealth and Rentals, everything that I do and everything that Michael does is based on education. It is about teaching you what we did to build our portfolio over the course of the last 6.5, almost 7 years. Our model is unique, our market is unique, and those two paired together create the best of all worlds. We focus on education, live events, mentorships, masterminds, and one-on-one consulting. If you want to learn more, you can visit our website or use that QR code below. I recommend, if you haven't already, you follow our Wealth and Rentals podcast. We're pumping out new information all the time. And then also our YouTube education channel. That is where our non-limited classes, like what we're doing today, you'll be able to find after the fact to rewatch, or of course share with those around you that you think would benefit from the information. And to stay up to date on everything that we have going on, please join our texting list. We don't spam you, I promise. And of course, you can always join our mailing list as well. If you haven't followed me on Facebook, I do recommend you do that. I post a lot on Facebook on a daily basis, from properties we're renovating to market updates, financial updates, nationwide updates, lots of things to keep you in the know of what's happening. And there's a lot happening right now. We're going into an election year, which means that there's going to be a lot of change in the financial industry and world. And so it's a great time to make sure that you are finding mentors and people, whether it's me or someone else, that you can listen to and then use that information to come up with what works best for you, what you believe, and where you're going to direct your investment journey. As always, everything I'm going to talk about today is going to be my best guess and knowledge based on years of experience, not only owning a real estate investment firm, but a property management company, being an investor myself, and just having worked in real estate for the last almost 18 years. I'm not an attorney, I'm not a lender, I'm not a CPA. None of the advice that I'm giving you today is specific advice to your situation. I'm not giving you legal advice, I'm not giving you lending advice. I am merely presenting you with information that has helped me on my journey. Our goal is to provide that information to you and then help you connect with others like me who are specialists in their own fields that can help you on your investment journey. As I always say, I'm one tool in your toolbox, and our goal is to help you build your entire team and be a sounding board and a resource for you as you find what's going to be your investment model that's going to work best for you. Of course, we believe our model is the best out there. We do believe it's the most resilient. but there's many other great models and opportunities to make money in real estate and other investment avenues. We don't have a crystal ball. Of course, we believe what we say. We believe in the power of real estate, the power of our market, and the power of the model, but all real estate is subject to risk and potential loss of capital. So let's recap. Last, we talked about the basics. So I want to just recap a couple of items for you, for those of you that maybe didn't watch the last one or you've slept since then. So I want to remind everyone, our 2 to 6 year model is what makes everything possible. So step 1 is we acquire property with max leveraging. Very, very important. Step 2, we 1031 exchange and sell property or cash out during years 2 to 6. And finally, step 3 is we acquire new property, 2 for 1, 3 for 1, depending on what the market has done, how long you've owned it, how much you put down, etc. So today we're going to be focusing on step 1. This is going to be a big one because, of course, it is the beginning of everything that you do. Next webinar, we're going to be focusing on step 2. And in between, what we're going to be talking about is property management and the actual rental ownership and success process of how you go from buying a piece of property to eventually selling or 1031 or cashing out that property. What does that in between look like? Because that's where a lot of people get lost. The life cycle of a property is very simple. It's kind of like the circle of life, except this is the circle of a property. So we're going to buy a property or properties with max leveraging. You're going to receive your monthly cash flow, tax benefits, principal pay down, hopefully appreciation. And then you're going to go back in and do your refinance or cash out and do a 1031 exchange. In our wealth and rental series, we cover this more in depth about how it works, why we do it this way, and how to know when it's time to cash out or 1031 exchange. We're going to talk a lot about that at our last webinar of this series. And then we're going to follow up with an in-depth webinar going over 1031 exchanges and how we make that work beyond just taking one property and turning it into 2. So as a reminder, real estate has 4 ways it makes you money. Rent income, so that's the monthly money that comes into your bank account every month. The appreciation, that's how much the value of a property rises. Principal pay down, that's how much equity are you paying into your mortgage every month as part of your mortgage payment. And then finally, tax benefits. So that's going to be your straight line depreciation or your cost segregation, depending on what your tax status is. So let's begin. Leveraging increases all 4 of these potential benefits. So again, if we think about all 4 items, the more properties you have, the more you're going to have of each one. Leveraging is for everyone. A lot of people think that, well, I only use lending or I only use a loan because I don't have the cash to pay cash for it. This is for beginners. It's not something I need to do. I have money, I have wealth. And that's just not true. It's very, very different than consumer debt, where we are taught that we don't want to take on debt and it's a bad thing to take on debt. And that's something that those who are financially struggling do. That's not the case. This is an asset that makes you money. So do not look at lending in real estate as the same as taking out a credit card or a payday loan or a cash advance or anything like that. Completely different. Even the top 1% leverage their assets to buy new investments. That's how they multiply wealth, and that's how they make money on borrowed money. That is how the rich get richer. Leveraging is what allows you to make your portfolio as large as possible, as quickly as possible. Our model is completely built around taking one bit of money, whatever you start with, and taking it as far as you can. Some people continue to add money and have money to keep going and keep going and keep going. And then there's other people who it's taken everything you have to save up that money to get started. That's your hard work, that's your inheritance, that's your 401k. And so we have to have a model that works around taking that nest egg and taking it as far as we can to grow wealth. So this is what that looks like. You have $200,000. You can either put $50,000 down on 4 homes. So of course that's 25% down. And that gives you a total net worth value of an $800,000 portfolio, or you can take that $200,000 and buy 1 home. When interest rates are low, that $200,000 will translate into 5 properties, not 4 properties. Leveraging allows you to buy somewhere between 4 and 5 times as many properties. Some people that are more risk averse, they might turn it into 3 properties, but at the end of the day, you are multiplying your benefit beyond just paying cash. I want you to imagine the power of doubling that every 2 to 6 years with that same initial cash investment. So your 200 becomes 800, your 800 grows. You go on and you go on and you go on until you're sitting here like me, sitting on a $40 million portfolio. It sounds difficult, it sounds complicated, it sounds like you have to start with a lot of money to do it, and that's just not the case. Leveraging is single-handedly the best tool to grow your portfolio. Every property gives you tons of benefits. We talked about those 4 ways it makes you money. And as you leverage, your return is going to go up on each of those benefits because you are getting 3 to 4 to 5 times the amount of benefit for that same amount of starting capital. Michael and I talk about the team member approach a lot. Every property is its own team member. So the more that you have, the more people you have splitting the workload, splitting the risk, diversifying the risk, and the more work or growth you then are going to accomplish in your portfolio and financial journey. With every property you own, not only does your lendability increase, but your net worth and your value is going to increase as an investor. And what's going to happen is you're going to find yourself having doors opened with better lending and better opportunities than what you have if you were just starting out with one home. There are so many benefits of leveraging. I've put a few out here for you. It's the greatest hedge against inflation because cash goes down in the bank, but real estate historically goes up. If you remember from last class, out of the last 81 years, only 7 years were down or at zero, and 2 of those years were 0 and 1%. Historically, real estate is one of, if not the safest investment over the last 100 years. You have a higher cash-on-cash return and more cash flow. More overall global return because of appreciation and principal paydown on 4 to 5 times the number of assets. Higher occupancy, lower vacancy percentage. It's a lot easier to get 100% or 90% occupancy when you've got 10 doors than when you have 1, because you have 1 vacant, you're 100% vacant. There's lendability benefits and access to better programs. We're going to talk about this today. Low cash output to purchase a property. You're earning money with the bank's money and you're reducing your financial exposure and risk as the amount of capital in every property decreases. And of course, we also know as the amount of capital decreases, the cash on cash return increases, as I've been pounding into your heads for the last however many webinars we've been doing. There's other benefits to owning more properties, right? You've got 4 to 5 times the tax benefits. Depreciation is on value, not equity. So a lot of people, when they think about appreciation, they think about, oh, well, it's just another 5%, like my 5% cash on cash return in my cash flow. But no, your cash on cash return is based on the amount of cash you have in the deal. That's your down payment, your equity. Appreciation is based on the entire value of the asset. You have 4 to 5 times the assets, higher global cash on cash return, especially when interest rates are lower. And you're going to increase your overall yearly income and benefits from these properties. So why should you not pay cash? This is huge. And this is one of the most difficult things for me to get through to people on when they've been investing in cash for a very long time, especially those that have inherited property. So let's look at some scenarios. These are going to be the assumptions that I'm going to operate with today. A purchase price of $250,000, rent at $1,750 a month, property taxes at $300 per month, and property insurance at $110 per month. Let's assume you paid cash for this $250,000 property, or let's just assume that you bought this property. Maybe you inherited this property. It really doesn't matter because at the end of the day, you have $250 in this property. And so we're going to run our numbers the same because remember, your equity counts as your down payment in terms of running cash on cash return. So your monthly profit is approximately $1,340 a month, and that's a 6.43% cash on cash return. So let's assume you finance this property at 6.675 interest on a 30-year amortization. And what I did here, guys, is I used numbers that our clients are doing right now. So we are looking at where are these properties today. So mortgage payment return, I've run it at 75% equity, so or 75% financed, 70% financed, and 65% financed. So what that means is you've either put 25, 30, or 35% down. Now, when we look at 75%, that means you put 25% down. Your cash flow is about $133 a month on this property, or a 2.55% cash on cash return. At 30% down, your cash flow is $213 a month. That's about 3.42% cash on cash return. And with 65% leverage, that means 35% down, your cash flow is $294 a month. So just over 4% cash on cash return. When we look at principal pay down, you're going to notice the invert. So right now, because rates are high, what you're going to find is the cash on cash return goes up as you put more down. However, in principal pay down, it's the opposite. So with 25% down, your return is going to be just over 3.2% cash on cash return. At 30% down, it's 2.52% cash on cash return. And at 65%, it's about 2% cash on cash return. So the overall global return difference between 25% down and 35% down is less than 0.25%. So this is really important because this talks about how, although your global return from just principal pay down and mortgage payment doesn't change a whole lot in cash flow, but what happens is on the backside where we look at appreciation, and then of course when we look at our refinance when interest rates drop. So if you had paid cash for the entire property, you would have made approximately 6.43% cash on cash. So negligibly higher return to have all of your risk and exposure in one property. But what if it's appreciating in value? And as you all already know, I only buy in areas that are appreciating. So let's look at our previous total cash on cash return. With 25% down, we're at 5.79, 30% down 5.94, and 35% down 6.03. So let's add appreciation. This year, most of the areas that we work in have seen in excess of 10%, but I went ahead and ran it at 5, which is a pretty stabilized appreciation rate. So in year one, on that one property, your benefit is $12,500. At 10% year one, your value is at $25,000 benefit, which means your true return also includes your principal, your cash flow, and your appreciation. So at 25% down, that is an additional 20% cash on cash return at a 5% growth rate, or 40% cash on cash return at 10% appreciation growth rate. And this is where the power of multiplying properties truly reigns, even in a high interest rate climate. 30% down, that's 16.67% or 33.34% at 10% appreciation. And at 35% down, you're still at 14.29% at a 5% growth rate and 28.57% at a 10% growth rate. Nationwide, average, they're expecting the year to end at about 9% appreciation, to put things into perspective. Making your total actual year one return with 25% down, 25.79% cash on cash return with a 5% growth rate, or almost 46% at a 10% growth rate. With 30% down, we're at 22.61 at 5% or 39.28 at 10%. And then finally, with 35% down, you're at 20.32 or 34.6 at 10%. Whereas if you owned it in cash, you made a 6.43% cash on cash return on your cash flow, no principal pay down because you have no mortgage, plus your appreciation of 5 or 10%, meaning a total return of either 11.432% or 16.432%. So depending on how much you put down, best case, it's about half, best case. Typically what we see is it's about a third to a fourth, far less than had you leveraged property. But hold on, you didn't pay cash, you bought more properties. So if you bought one property, and this is where it gets tricky, so follow me here. You had $250,000 and one property appreciating, meaning that you either gained at 5% $12,500 or $25,000 at 10%. If you leveraged, you bought 3 to 4 times as many properties. So instead of making $12,500 or $25,000 year one, you made $50,000 or $100,000 year one on the same amount of cash you put out. So what do you think that does to your cash on cash return and your overall global return? So for the one you owe in cash, you made 6.43% cash on cash return plus appreciation of 5 or 10%, meaning a total return of 11.43 or 16.43. So one cash property, just over 16,000 cash flow plus your appreciation, total profits 28,550 or 41,080. But let's assume that you'd leveraged at 25% down and bought 4 properties. So 4 financed property is a cash flow of 1598.52 each, or about 6,400 for all 4. Principal pay down of just over 2,000 each, or over $8,000 for all 4. Appreciation of 5% is another 50,000 for all 4, or at 10%, that's 100,000 for all 4, meaning your total profit year one for 4 properties is over 64,000, or more realistically this year, more than $114,000 in 1 year. This is why you leverage. Now, I want you to imagine when interest rates drop and you refinance these properties, what these numbers are going to do. You think it looks good now? Wait until rates are back in the 5s or low 6s. But what about the tax benefits? Because $250,000 leveraged into 4 homes is $1 million in real estate. So say that your basis for each property is $200,000 each. That's an $800,000 basis. So it's straight line depreciation. That's $800,000 divided by the 27.5-year life. That's over $29,000 per year in depreciation. Or if you cost segregate because you qualify for that, then we're talking $800,000 in basis times about a 30% year one benefit times 80% that we can take this year. That's about $192,000 year one benefit. Now imagine that cash on cash return. So I'm going to get off my soapbox about why we leverage. Obviously, you want to learn about leveraging. That's why you're here. If you've been working with us, you already are leveraging. So let's talk about leveraging. Let's talk about all the different ways that we use it and what you need to know. So the first thing that I've done is I've put together the terms that I recommend you know and understand. So let's go through these. LTC is loan to cost. What that means is when there is a rehab being done, you can find loan programs that allow you to look at what the overall cost is and what the overall value is. And if at the end of your rehab and purchase, you have equity that has been captured, you can actually use a loan to cost program to use some of that equity as down payment. This is not something you're going to start with day one. This is something you're going to graduate to as you move forward in your portfolio. Today in my portfolio, 99% of what I do is loan to cost lending. So let me give you an example. You are doing a program that is an 80% loan to value LTV. So 80% loan to value must mean that you have 20% equity at the end. But let's say when you're done, you actually have 30% equity, but the loan program only requires 20. If you had a loan to cost of 90%, 100%, you could then take that equity and use it towards down payment and walk into the deal with 10% down, which is what people like me do all day long. So that's loan to cost. Loan to value, again, is how much equity do you need to have? What is the ratio they're going to allow? So an 80% LTV means that you have to put 20% down. A 65% LTV means you're putting 35% down. DSCR is a debt service coverage ratio. We're going to talk about that in depth in a little bit. Fannie Mae is also known as conventional lending. So that's where you hear 10 doors. That's Fannie Mae. ARV, that is your after repair value. That is what the home is worth once it's been fixed up. An ARM is an adjustable rate mortgage. That is a rate on a mortgage that will adjust at set intervals. Typically 5 years. We do a lot of 7 years right now, but that is the period of time where the rate is fixed. And at the end of the fixed period, it can either be an adjustment where the rate goes up according to set parameters, or it could be a balloon, meaning that the loan is due in full. A portfolio is a bank-held mortgage. Again, a balloon means that loan is due in full. And amortization is the amount of time that principal payments are spread out over. So that's how many years are you spreading the principal you are paying down. So the loan balance, how many years are you spreading that across? And the fixed period is how long of a time period the interest rate is fixed or set for, meaning it will not change. So when we talk about leveraging, one of the first things we want to talk about is what does it cost to leverage? Most loan programs require 20% minimum down. In low interest rate climates, you will do 20% all day long. In the current rate climate, you should expect 25 to 30% to achieve worthwhile cash flow while still preserving acquiring as many appreciating homes as possible. Closing costs vary based on the type of the product. We're going to talk about this in a moment. And then we're going to talk about this a lot on our 2 to 6 year model and how that looks on the resale or cash out. Very important not to use all of your cash. We talked about this last webinar, but I want to reiterate this. You should not be using all of your cash on lending. And if you are doing rehabs, make sure that you keep a significant nest egg for a rainy day. So let's start with conventional lending. This is the most common that people use to get started, and many of us use it and then refinance into other products we're going to talk about and go back into Fannie Mae. So to qualify for Fannie Mae, the property needs to be either a single family, a duplex, a triplex, or a fourplex. So 1 to 4 family only. And there are condition requirements. If the property has major issues, it will not go Fannie Mae. The requirements that they're going to be looking for and things that they're going to set as parameters are going to be the amount of reserves that you need to have, a max DTI or debt to income ratio, a credit score requirement with adjustments every 20 points, and then a vacancy factor. So let's talk about these. In reserve requirements, the bank is going to require you have reserves after your down payment and after your closing costs. With Fannie Mae, it's going to increase as you own more property. So for your first 1 to 4 financed properties, you'll have to have 2% of your principal balance in reserves. When you have 5 to 6 financed properties, that's going to go up to 4%. And then once you get to 7 properties, all the way up to 10 financed properties, you're going to need to have 6% reserves of your principal balance. For debt to income, Fannie Mae is going to max out at 50%. However, when a lender runs you, they're going to put you through an automated underwriting system called DU, that's Desktop Underwriter. And it will determine if potentially you're not going to be allowed 50% max. It may reduce that. And that's going to be based on your credit profile, your assets, etc. Most people who are in the process of investing, and certainly the clients we work with, typically 50% is what we see. But if you have blemishes on your credit, you have not any credit, those types of things, the automated underwriting could reduce that. Credit score is really important with Fannie Mae. What's considered top tier is 780, and that's going to be your best rate that you can get. And then every 20 points you go down, your rate is going to adjust upward. So 760 will be higher than 780, 740 will be higher than 760, so on and so on. And remember, new loans will go on your credit if in your personal name, and that can affect your score too. Although the stronger your credit, typically we don't see a huge effect. Like if I take out a loan now and put it in my personal name, it hits my credit, I typically don't get a ding. It'll show, but it's not going to take my rate. The vacancy factor is really important if your DTI is tight, because of every property that you buy, they're going to take 25% of the rent and they're going to count that against you. Basically, what they're looking for is room to cover what they call the vacancy factor to make sure that you can still afford the property if it's vacant. Obviously, none of us expects 25% vacancy. That would be terrible. However, they want to be protective and they want to be very conservative. And so that's what that looks like. So for example, if you're buying a property that rents at $1,600 per month, there'll be a $400 a month per property factor adjustment. So if you are $300 away from being at a 50% DTI, this would make it where you don't qualify. So the way that you can finagle that is buying a property if it's really, really tight where the rent ratio works. Maybe like you need a $1,400 a rent property instead of $1,600, so spend less. Lots of ways to finagle that, but generally people aren't right on that cusp of 50% DTI. So for the terms with Fannie Mae, what you're typically going to see is a 30-year amortizing product, meaning you have 30 years to pay it back, and it's fixed for all 30 years. The minimum down on Fannie Mae for single family is 20%, and once you go to 2 to 4 family, that goes up to 25%. You should also know that on 2 to 4 family, the rate is often a little bit higher than on a single family home. There is no prepayment penalty, meaning if you pay the loan off earlier, there's no fee for that. And the loan closing costs are generally quite low. What I typically see is about a 1% origination fee. One thing to keep in mind with Fannie Mae is that if you cash out refinance, you are maxed at 75%. There is the 10-door rule, but keep in mind that that is 10 tax ID parcels, not 10 physical doors. So in theory, you could do 10 fourplexes if each fourplex is individually parceled as a one building 4-unit property. Fannie Mae can only be done in your personal name. However, you can deed it to an LLC after closing. Each spouse can qualify individually or jointly. So if you and your spouse work and both of you have a DTI below 50% individually, you each can get 10 doors. But keep in mind, if you are on one of the loans together, it will count against both of your 10 doors. There are also seasoning requirements of funds, meaning that don't go do a home equity line of credit, pull $300,000 out and think that you're going to use that for down payment the next week. That is not how it works. You can certainly do that process, but there are seasoning requirements. There are also seasoning requirements for cash out refinances on a property. So don't think that you can buy a property for a great deal today and cash out refinance it tomorrow. Not with Fannie Mae. Some noteworthy items. There is a heavier amount of paperwork over our bank products with Fannie Mae. Again, it will hit your credit. It will show on your credit. And these loans are typically sold to a servicer. So whoever you do your Fannie Mae loan through will typically not be the company or the entity that you are going to be reporting to and dealing with for your duration of ownership. It's not a negative, it's just something to keep in mind. Now, I want to remind you, and I'm sure you can understand from a cash flow perspective, your number one priority right now is the longest amortization possible. When interest rates go low, very, very low, sometimes going with a 25 or a 20-year AM will make sense. Right now, while rates remain above 6%, your number one priority is the longest amortization schedule possible so that your payment every month to your bank is as low as possible, preserving as much cash flow as possible. So let's compare a 25 and a 30-year AM. I just had my team send me a random property. This is one of our new construction properties. Purchase price is $250,000, so it fits our metric perfectly. This particular property is going to be the same property I'm going to use across all of these examples. So this property is $250,000. You put $75,000 down, and we are just going to hit it right in the middle. So instead of doing 25 or 35, we're going to do 30% across the board here. But of course, if this is something you're interested in, we can always run numbers at the other intervals of down payments as well. So when we look at a 25-year amortization, our monthly cash flow is going to be $190 per month on this example, or $22.78 per year. This does not include your principal pay down. This is just the monthly cash flow that comes into your bank account. On a 30-year amortization, that cash flow is going to go up to $265, or $31.72 per year. So in this case, the cash flow increase between a 25-year am, or 25 years to pay that loan back, versus a 30-year amortizing product, there's $75 more cash flow. So this is why I'm saying a 30-year amortization, or as long an amortization as possible, is very important. Because if you had 10 properties, this adds up very quickly. You get 40% more cash flow at current interest rates on a 30-year over a 25-year. And then the overall higher cash on cash return on just the cash flow is just over 1.19% higher. But I want you to remember, even if you do a 25-year AM, you're not losing that extra money. It's paying into your principal every single month. So globally overall, you're still earning that money. You're just not seeing it come into your bank account as cash flow. You're seeing it pay down principal on your property. Let's talk about direct bank lending in the personal name. This is a form of portfolio lending. This is what we are recommending most of the time right now. It's virtually the same as Fannie Mae, except a few things with the program that we use. The bank is going to hold the loan, meaning that they're going to keep and service that loan. So you're building that relationship that's going to be very important as you move forward in your investment journey. These are often 5, 7, or 10-year fixed programs with lower rates. So they're still amortized over 30 years. So they act as if you're paying it back over 30 years, but the rate is only fixed for a set period of time. The program that I'm recommending right now with the bank that I recommend is a 7-year fixed product, 30-year amortizing, because we know no one's going to be sitting in these loans 7 years. Any loan that you take right now, the minute interest rates drop, you're going to want to go refinance and likely cash out. So again, that's a 30-year amortizing product, and they're easier to qualify for, especially if you're not a standard W-2 employee. If you're someone that has inheritance, or you show losses on your tax return but you have huge assets, because these are direct bank programs, they often have a lot easier ways to qualify people that don't really fit in that cookie cutter box. However, even if you have an inheritance or a trust, and that's where your income or assets are coming from, even my Fannie Mae lender has options to set up ways that they can use that. Essentially, they'll amortize it over the amount of the loan, and there's lots of specifics with that. But we do that every day, people who aren't working but that do have cash or assets. Now let's talk about portfolio or commercial lending. So this is going to be the type of lending that someone like me is going to use. So portfolio, again, as a reminder, means bank held. So the eligibility for these properties is pretty wide. It doesn't have to be a 1 to 4 family property. It doesn't have to be perfect condition. Every product is going to be a little bit different, but generally this is going to do both small multifamily and 1 to 4 family under the same roof and the same umbrella of product. There's typically no limit by policy, meaning that the bank is only going to let you have 10 doors. It's really more by qualification of what the bank's limit is going to be, either for you because of what your specific asset, and situation is, or what their policy is before it has to go to what's called committee. So for me, when I go to a new bank, typically they're going to say, okay, well, we'll approve you for up to 5 million or up to 8 million, but after that, you have to go to committee, and then the committee votes on what they're going to allow you to lend. And if your finances are in order and your books look good and all of that is good, then committee's not something to be scared of. But if you're someone that maybe you don't look perfect on paper, then committee can be something that might be a problem, or they might think you have too much risk exposure in commercial property, things like that. So typically when you're later along in your journey, when we're dealing with these banks, that's when we look at something like a committee approval. But most of the time for these types of products, the person that we're going to refer you to, or the direct bank officer you're going to be dealing with, actually will have signature authority up to a large sum of money. So like for me, when I go to one of these people to go get a loan on a fourplex or a duplex or whatever, the person that I'm working with only has to get one signature to get that loan approved. And so these are just a very easy product to work with, and they're extremely beneficial in building your portfolio. And you can build these relationships with multiple banks. You don't have to just do it with one. You can put it in a personal name, a trust, an LLC. They're usually pretty flexible. There are a few companies that maybe they're not going to want an LLC or a trust from certain states. And that's just because of the difficulty in accessing the LLC in those states. But like if you have a Texas LLC, that's easy all day long. The amortization can vary. It's typically a 20 or a 25-year AM on the commercial product side. On residential, we can often get them to do a 30-year AM. It really just depends. Of course, if the market is struggling, so like if you go back to 2010, 2011, they're going to be stricter on the policies for these programs than what they are in a good market like what we're seeing right now. The fixed period typically is a 5-year, and then we see one of two things happen after year 5, either a balloon where you're refinancing, or where it has 1 5-year extension where the rate adjusts to set parameters. I typically ask the bank to structure mine as a 5-year with a 5-year adjustment, but I've never had one hit the 5-year without having been refinanced, because again, that would be not following my own model. One of the great things about these programs is they start at 20% LTV loan to value, and most of the ones that I've worked with allow cash out up to 80%, unlike Fannie Mae that caps you at 75%. And remember, when interest rates are lower, you're going to want to be leveraged heavier than what potentially you might be this year until rates drop. The process and costs, again, are very simple. It's a lot less paperwork than when you're dealing with Fannie Mae. Most of the time, what they're going to ask you for is a tax return, a personal financial statement, and they might verify your cash holdings or your assets. So if you tell them you have $100,000 in the bank, they might want to see a bank statement, especially at the beginning of working with you. They're very flexible. They can use different types of assets and things to work instead of cash, having to have a cash income. So having to have a W-2 job, a 1099 job, things like that. It's typically an origination fee of between 0.5% and 1%, and there's rarely a prepayment penalty. In fact, I have never dealt with a direct bank personally that has a prepayment penalty. The only time that I've seen prepayment penalties are when you work with a mortgage broker, which I don't recommend, or if you are doing a DSCR product. We'll talk about that in a minute. So one of the benefits of this is you can preserve your Fannie Mae slots if you're using them. They do have loan to cost options like we talked about, where your equity is down payment up to 1% of cost. They do have the rehab options if you're doing that. Now, a lot of people, what they do, and this is not what I recommend, is they buy a property, they do hard money lending, they fix up the property, and then they go refinance on the back end and cash out. The banks that I work with, they do that process all in one loan. So it's one loan, one interest rate day one. They often do an interest only period to help you with cost during vacancy, and they roll the rehab into it and you do draws on the rehab. So much, much simpler than the old school BRRRR model that I don't recommend. And then of course, blanket loan options. So this is a way where you can, someone like me will say, I have 10 properties I want to refinance, and you can go take all of those 10 properties and put it into one loan. The benefit of that is on the closing cost perspective, it drops just a little bit because you're not paying a doc prep fee across 10 properties, et cetera. However, the negative of blanket loans is a lot of people do these and they don't get release provisions written in there, meaning that if you sell one of the properties, the bank may not let you take the proceeds to go 1031. So if you do a blanket loan, it's very, very important that you get release provisions written in, and release provisions at only 100% of the remaining aggregate principal balance of that one property. Often I see release provisions at like 120%, meaning that 20% of your equity is going to have to be paid back to that bank. And if you're buying these with 1031 exchanges, it can actually blow your exchange. So really, really important that you, if you're going to do a blanket loan, which I do them all the time, that you get proper release provisions where you can sell one property off. It's predetermined what the value of that one property in the portfolio is and what that's going to look like. Very simple to do, very impossible to fix on the back end. So something you want to make sure you do upfront. And the same goes for DSCR lending. As we discussed this, a lot of DSCR lending is like a blanket loan. It's lots of properties in one loan. Make sure in black and white you have your release provisions in your loan documents. Now, DSCR lending is when interest rates are low, where 99% of you are going to refinance your properties too. The biggest regret I have in the last 3 years is that I was so busy that I probably refinanced 60 or 65 properties onto DSCR last year, and I wish I had done like 150. But I didn't. I did a lot, and it felt like a lot at the time. And looking back, I should have done more. I'm still locked into great rates, but the great thing about DSCR is it's 30-year amortizing. And so when you're in a lot of commercial product that's 25-year am, going to that 30-year am is a huge difference on cash flow. So lesson learned. I'm one to admit my mistakes, and I definitely recommend that as soon as rates drop to a low level, so we're talking upper fives, go put everything on DSCR that you can. And of course, we'll be keeping you guys updated on what rates are doing, what programs are doing, so that you know when that time is. Now, to calculate the DSCR, you're going to take rental income and you're going to divide it by your total payment. So that's principal, interest, taxes, insurance, and association. So principal is the principal of your loan, how much you're paying back to principal every month. Interest is how much interest are you paying to your loan every month. So your PI, that's your mortgage payment. T, that's your taxes, your monthly tax amount. I is your insurance, that's your monthly insurance amount. And A is if you have a homeowners association. And that's going to tell you what your DSCR is. So an example, that same $1,600 rental income minus, let's say that your PITIA is $1,400, that would be a 1.14 DSCR. The requirements for DSCR are really quite simple. It's the property. Is the property cash flowing, and does it meet the DSCR requirement of the loan? So they're usually going to look for somewhere between 1.1 to 1.25. Sometimes I see them look for 1. It really just depends. So this is kind of in lieu of a vacancy factor. So instead of taking a hit on the property for the vacancy factor, look at this more as they're looking at whether the property makes enough money to cover the debt with some fluff. Now, some DSCR programs are 1. And so then that's obviously not an issue, but it's very, very rare that we have a property that doesn't meet the DSCR requirement. In fact, in all of my dealings over the years, I can only think of one property I had that didn't, and it was a commercial property. And commercial is just a very volatile thing, not something I recommend. I inherited it as part of a package of like 20 properties I bought, sold it as quick as I could. But DSCR in the single family side is usually very, very easy to meet. If it doesn't meet the DSCR requirement, probably not a property you should be buying. It is usually 30-year amortizing, and it's often 30-year fixed. So this is where really the power of DSCR comes in. There's often no income verification. The rates are not that much different than normal rates, but the fees are higher. So unlike all the other products where the fees are 0.5% to 1%, DSCR is usually going to be 2 to 3%. Sometimes you can find one at 1.5%, but there are higher upfront fees. And so typically when I put a property into a DSCR, that is a property that I am intending to hold, and I'm being very strategic with my refinance to make sure, talking back on the things we've talked about in previous webinars, how do you know whether to 1031 or cash out? If this is a property that still makes sense and it's one that I would buy again, that's when that cash out and that DSCR makes sense. There's also often prepayment penalties. It's typically a 5-year taper, meaning that the first year there's going to be a higher prepayment penalty than year 5 when the prepayment penalties end. Some of them are shorter, some are a year or 2, and you can also sometimes pay a bit higher on the rate or fee to get a lower prepayment penalty. And if you're doing a big package, often you can even negotiate the prepayment penalty and the upfront fees with them. Don't think that because they tell you this is the cost of their program that they won't negotiate, because that is not the case. So DSCR is a wonderful tool, especially when interest rates are low. The reason you wouldn't want to do DSCR in a high interest rate climate is because you're paying a big fee to get it. There's a prepayment penalty, and there's no chance you're going to keep that higher rate once rates drop. Now, in my experience, sometimes the appraisals come in a little bit lower on DSCR than regular property. However, I've had many DSCRs that come in way above like a Fannie Mae appraisal. So it really depends on who you're working with. It's not as guaranteed a closing as a normal loan because you're not really locked. They'll tell you you're locked with your rate, but the way that they get their money to do DSCR, it can blow up at the last minute. So for example, I was in the middle of a DSCR right when rates started to go crazy, and they could no longer close at the rate I was locked at because their entire lendability just disappeared overnight, because where they get their money from kind of disappeared. So I typically work with DSCR that gets their money from the insurance pool. So it's just where that money is coming from. Is it coming from insurance companies? Is it coming from banks? Is it coming from, there's just so many different ways and places it can come from. And if they're getting it from a guidance line or from different types of lines of credit, that's where you can see things kind of fall apart. But that's not to say that they typically blow up. It's very, very rare that they do. You just want to make sure you're working with a company that works in a timely manner and that their money is coming from a place that's not at risk. Now, once you're closed on the DSCR, you don't care where the money came from. Underwriting and rate locks are different, as I mentioned. Even underwriting is different because they're really not looking at you. Some of them are going to look at your credit score. Some of them are going to look and make sure you've never filed bankruptcy. Some of them don't care at all about you. They only care about the property. So DSCR, in terms of qualification, is by far the easiest. And again, remember that you can do them in bulk, but you can also do them solo, and make sure you negotiate the deal with them. Now let's talk about taking advantage of a high interest rate climate. As I've talked about, I'm calling this the pause, and the pause is pretty much over. Things have picked up significantly. I don't know if you saw the numbers that have come out the last month, but everything's just growing like crazy. We had a very, very normal prime season other than the shortage of housing. So it really is a great time to buy, but you should only buy rentals that have positive cash flow. There's a lot of people out there right now saying to buy everything and don't worry about cash flow. That's not true. You have to have a property that cash flows. And if you find a property you fall in love with that doesn't cash flow, don't do it. The bottom line is it's not going to cash flow as well as it will if rates are at 4%. But at the end of the day, when rates were at 4%, we were all paying 50, 100,000 over asking. So you can manufacture lower interest rates again. Rates can drop. But what you can't do is manufacture lower housing prices again. And that is why it's so important right now to be taking advantage of what's going on. Because the minute the interest rates drop, you think the rates and everything are affecting value right now. And value is going up. Imagine what's going to happen when rates go down. Anyone and everyone that didn't buy last time or that wants to move is going to do it. Because again, we're in a huge housing shortage, all the things that we talk about, right? But at the end of the day, everyone that's kicking themselves right now, they are going to jump when things go back to a more normal level. And we're really not that far above normal, guys. When you look at historic trends of interest rates over the last 50, 60, 70 years, we're negligibly higher than what the average is. We got very spoiled in COVID at what is not normal and what likely will not happen again. The higher the interest rate, the lower the cash flow and the lower the cash on cash return. So very, very important that you weigh the pros and cons of buying down these interest rates. And we're going to talk about buy downs in just a moment. So I want you to consider a $250,000 home with 25% down. At 8% interest, the principal and interest payment is $1,375.81. At 6% interest, the principal and interest payment is $1,124.16. So just that 2% interest rate drops is a difference of over $251 a month. So that $251 and some change every month for a full year, divided into a down payment on this at $62,000 and some change, basically means that just that interest rate drop is going to increase your cash on cash return by almost 5%. So if you're buying a property today with a 4 or 5% return, just on refinancing that property when rates come down, your return is going to double. And that's on the cash flow side. So this just goes back to, it is really, really important that you're taking advantage right now while you can. Now let's talk about rate buy downs. And my husband picked this picture on the right. He's like, you have to put fire because they're just burning money. And he's right. He's right. If you're on my social media, you've been watching my videos, you know that I'm not a fan of buy downs, because the average break even on a buy down is somewhere between 39 and 45 months. So what that means is if you pay to buy down, you're throwing that money away. And you are banking on the fact that you are not going to be refinancing that property in the next 4 years. That is what you are banking on. You are saying to yourself, rates will not come down for 4 years. I don't believe that. I don't know anyone that believes that. So if the seller is willing to pay, because this is the argument I keep getting from people, well, I'm not paying for it, the seller is. No, you're still paying for it because your net is your net. And so if the seller's willing to put $5,000 into a rate buy down, it's way more advantageous for you to take $5,000 as a price reduction, because that's not throwing money away. That is gaining equity for you. Your buy down on that rate is gone. The minute you spend the money, it has disappeared. So the only time I recommend doing a buy down is if you need it to qualify. Now, I do have one of my lenders who, with 35% down and 1% buy down, has a very, very good rate right now. So I'm a little wishy-washy on that one. And so if you wind up going with the 7-year product and you're looking to do 35% down, it might make sense to do the 1% down because the rate is one you really could sit in for quite some time. However, generally, as a general consensus, do not burn your money. Now let's talk about the role of interest only in ARM mortgages, because in a high interest rate climate, we don't need a 30-year fixed product because we're not going to sit in one of these rates right now for 30 years. Both interest only and ARM mortgages are a fantastic tool to use when rates are up, because you've got this really high chance that you're going to refinance anyway. So when you're looking at an ARM mortgage, we're going to increase cash flow because the rate's going to be lower. And if you're not doing Fannie Mae, you're not going to be in a 30-year fixed anyway. It's a great time to do ARM mortgages like the 7-year product I recommend. And in terms of interest only, as long as you're in a price growth market, it's an incredible way to increase cash flow because you're not paying a principal payment. So at the end of the day, the global return is the same, whether you're paying the principal to your loan balance or whether it's coming to your account in cash flow. But if cash flow is a #1 goal for you, like you're trying to retire today, or you're trying to put a kid through college, or whatever your why may be, interest only can be a great tool. So in a low interest rate climate, I strongly recommend refinancing all properties to low interest rate DSCR financing. Your choice whether you do interest only or not. So let's look at the difference between a 30-year amortizing product on the right and an interest only product on the left. So again, same example, the $250,000 home with $75,000 down. On the left, in the interest only, your cash flow coming to your account every month is $418. On the right, your cash flow with the principal and interest is $265. So the difference, of course, is the principal that you would be paying on your amortizing 30-year loan. So there's a cash flow increase of about $153. That's 58% more cash flow. And the cash on cash return on the front end is 2.44% higher. But once you calculate in the principal pay down that you're paying down every month, the overall cash on cash return is about identical. Now, what I want to leave you with is, what is leveraging bound financing? There are so many ways that we leverage, and taking out loans is only one of them. Leveraging the people around you, the resources around you, those who are educating, those who have done this before, those who have done it and failed. What can you learn from them? Education is really a form of leveraging. And so I'm going to leave you today encouraging you to leverage everything you can, not just in real estate, but also in learning and people's time and your time. Leveraging is one of the greatest tools there is to building a real estate portfolio, and it is so much more than just the loans that we take. We do have an incredible mentorship program, and I'm not going to touch long on this, but we are one way that you can leverage. And whether it's joining our elite program, which I talked about last time, where we really look at how we can give back and how we can build others, or whether it's helping where you can leverage to help other people. Being a mentor, having a mentor, even those of us that are mentors, we have mentors. And so it's very much a whole team sport. We are all on the same team. We are all in the same boat. We are all in this together. And hopefully we're all doing the same model. And so whether you find a mentor today or you're still looking for a mentor, whether you are being a mentor, I encourage you to get out there and be active and leverage not only what you can take from others, but what you can give to others. Very, very important. And this is why we have our small elite group that not only are we giving to with our time, but also they're giving to each other. I do want to mention just again that we do consult calls. I do them personally. They're anywhere from about 20 to 40 minutes, depending on your situation. They cost, I think, $125. I did about a dozen of them after the last webinar, and they're really impactful for you. If you're kind of feeling lost on what to do next, you're just getting started, you're sitting on a portfolio and you're not really sure what to do next, I'd love to talk with you. Of course, you're going to send us a lot of intake information before the call that I can review. It's really a great value, and I say that because I've seen the power of what it can do for people. And if you're not doing one of these consults with me, find someone that you trust to consult with, because just bouncing ideas off someone that's been there and done that and is a step ahead really can do amazing things for you in your journey. Again, our next webinar is going to be October 19th from 7 to 8, the backbone of profitable investments, the tenancy. This is a very important one. I love to teach this, and we have 100% new content coming for this webinar. And then, of course, again, our bus tour is on October 13th. We would love to see you there for this free event virtually. 3 upcoming in-person bus tours talking about how we scope our markets, why we believe in these markets, and what the type of properties we are doing is. And then our in-person wealth and rentals weekend with our bus tour and conference, and then party on Saturday. Again, I invite you to join me October 10th, even if you're not looking to invest in a fund right now. I love to learn as much as I can about other investment opportunities and models. And so it's a great way to learn what this looks like. What is a fund? When does a syndication? How is it different? Is that something I want to work towards? I do want to remind you that all of our funds do require you be an accredited investor. If you have any questions on what that is, you can visit our website. Finally, I encourage you to follow us on social media. As I've mentioned before, Facebook is the #1 I recommend, because that is 100% me personally. Otherwise, I thank you for taking time out of your day to listen to me, and always here to help. We encourage you to submit your questions so we can answer those on social media. And I look forward to speaking and seeing many of you soon. Take care. Have a wonderful rest of your week, and I will see you in a couple weeks.